Convergence.
What happens when these contracts reach expiry?
As we have discussed, the cost of carry denotes the difference between spot and futures prices. The futures are normally traded at a price higher than the spot price. This gap keeps reducing as time progresses, and finally both these prices merge at the maturity of the futures contract. This is called convergence. Convergence is essential for a fair and functioning derivatives market.
Why must convergence happen?
A futures contract is ultimately a contract linked to a real physical commodity. When there is large time left for expiry, say 2 months, the cost of carry will be higher. This is because the longer the time left for expiry, the higher the cost factors such as financing, storage, insurance, handling, etc. In the previous example, the 2-month cost of carry for copper futures is Rs 60. As the expiry date nears, the cost of carry also reduces. When there is 1 month left to expiry, the cost of carry may become Rs 30. Finally, near the expiry, say 3 days, the cost of carry becomes very small, say Rs 5, because it hardly costs anything to hold a commodity for 3 days. And on expiry, the futures and spot prices become the same. The MCX exchange also enforces this discipline in the futures expiry mechanism. This is why cost of carry reduces and convergence happens.
Got it. Convergence keeps the market fair for all.
4. Convenience yield and backwardation.
Is there ever a case in which there is an advantage to holding the physical goods instead of a futures contract?
Yes, in some cases, there is a benefit of physically holding the commodity instead of a futures contract. This is called convenience yield. Convenience yield indicates the benefit of owning a commodity rather than buying a futures contract on that commodity. Convenience yield can be generated because of the benefit from ownership of a physical asset. Convenience yield is usually not there for financial assets such as equities or bonds. Holding the underlying bond or stock does not add any additional value compared to holding a futures contract on the same bond or stock. However, commodities, especially agricultural commodities, have a convenience return because they form part of a production process. The production process requires availability of the commodity at all times to continue to operate at economical costs.
Can you give me an example?
Yes, let's take an example of a stainless steel factory that needs nickel. India imports a large part of its nickel requirements. Factories needing nickel are willing to pay a premium to have ready nickel supply when there are geopolitical supply shocks, say war in a nickel exporting country, shipping disruptions, sanctions on nickel producing countries. Steel manufacturers need nickel to keep running, and they may need to stock nickel as a strategy. Hence, the convenience yield may be high in the above situation. In agricultural commodities, seasonal fluctuations can result in high convenience yield. The futures price equation we mentioned earlier can be updated as follows: F equal to S plus C minus Y, where F equal to futures price, S equal to spot price, C equal to cost of carry, and Y equal to convenience yield. If convenience yield is high enough, then Y is high, then futures price may go below spot. This is called backwardation. Backwardation in agri-commodities. Backwardation is common in agricultural commodities because physical supply is tied to harvest cycles and cannot be increased quickly. Suppose cotton is trading at Rs 62,000 per bale in the spot market, while the 3-month futures price is Rs 58,000 per bale. The spot price is greater than futures price. The market is therefore in backwardation. This may happen after a poor harvest has created immediate shortage of cotton. Textile manufacturers still need cotton to keep their factories running, so they are willing to pay a high price for cotton available today. However, the market may expect the next harvest to increase supply in 3 months. Therefore, cotton for future delivery is priced lower. And based on such information, a farmer can make a decision to sell his crop right away or hold on to his produce for a longer period. Backwardation is especially common in agricultural markets because crops are produced seasonally. Droughts, floods, pests and poor harvests can suddenly reduce current supply. Agricultural goods may deteriorate or may be costly to store. Farmers cannot immediately produce more crops when spot prices rise. Processors often need the physical commodity immediately to continue production. This concludes our lesson on futures pricing and the relationship between futures and spot prices. We will deal with this topic in greater detail in later videos.
Thank you. Now I understand backwardation and why futures prices can trade at a discount to spot prices.